Let's go ahead and jump in here. Yeah, what I was mentioning or trying to mention got garbled up a few times, but yesterday we had the Fed come out with a 50 basis point cut, and there's a lot of debate. Some are saying it was a good move, some are saying it was too early, some are saying it's not going to help. I kind of feel like it was a move that was necessary, and from my standpoint, it was more about inflation being so low, and the dollar up until the last couple of weeks, the dollar had been setting some new recent highs. And, the way to inflate the economy is to weaken the dollar. The way to weaken the dollar is to lower interest rates. So I've been calling for a rate cut because of inflation concerns more than economic concerns, more than growth concerns. But I think with the coronavirus, I think that adds one more reason why the Fed should cut. And there are plenty of folks who say, well, a Fed cut isn't going to help a health crisis. Well, it provides confidence, and confidence is really important when you get into a situation where everyone is fearful. So I do think that it's something that was necessary, and in my opinion, I think it was a good thing. We'll see. But let's take a look at go ahead and share here. All right, so now taking a look, hopefully the voice stays with the sharing of the screen. But you can see the Dow Jones Industrial Average down almost 800 points yesterday, the S&P down 87, the NASDAQ 268, mid caps down 40, and small caps down 19. If there was one good thing, it was that finally we got a little bit of outperformance in mid caps and small caps. And obviously that was a small thing, but it is at least a thing. Looking at the individual groups, well, the selling was where I would have expected the selling to be. Technology, financials, communication services, three aggressive groups got hit. And in fact, in the daily market report, when I sent out earlier in the day yesterday, I mentioned one of my concerns early on was that the defense, everywhere you turned, money was rotating towards defense. Now futures are really up today. We've got the Dow futures currently up over 500 points, at least last time I looked. That is, it's a positive, but let's keep it in the context of what we have here, which is extreme volatility. 1 minute you're up 500, the next minute you're down 700. So yeah, it's good. I do think eventually that this is going to pass and that we're going to continue our secular bull market advance. And I'll be honest, I mean, the fact that interest rates are even lower, that increases the value of earnings going forward even more so than what we had before. But earnings are so cloudy right now, and economic conditions 3-6 months from now are so cloudy that folks aren't willing to put capital to work. That's the biggest problem. So we've got to get a little bit more clarity, I think, on the coronavirus and the impact it's going to have before I think the market is really ready to move back up to the upside. Now, if we just turn around and head right back to highs in the next 2 weeks, then there's been some serious manipulation, in my opinion, that's taken place in the market, because I don't think that clarity comes in 2 weeks. Clarity is going to come probably over the course of the next few months. But so we'll see how this all plays out. But again, from a long-term perspective, I think this is an opportunity to buy at cheaper prices. Could they go lower? Sure. But you're not worried about next week if you're a long-term investor, or next month or 6 months. You're worried about where you are in 10, 15, 20 years. So I think that the selling that we've seen is an opportunity for a long-term investor. Short-term trader, that's where it gets dicier. For me as a short-term trader, cash is king. Cash is my business. Cash is, obviously it's my capital, but that's my business. And if you lose that cash, it's much more difficult to stay in business. So when things get really volatile like this, and it's literally a coin toss from one morning to one afternoon, or from one day's close to the next day's open, putting your capital to work, large chunks of it, it's a lot of risk. And so short term, I'd rather invest in 6 months with the market back at the highs, knowing that all of this is behind us, than trying to jump in here in the short term, not knowing if we're going to have another leg down. I mean, there's nothing to say that the market doesn't, move down, another swift move to the downside. I've pointed out a couple of key levels I'd be looking for. 2720 on the S&P 500 is a big level. If it goes below there, it could be 2350. I think 2350 would be a major long-term level. That's the selling that we saw back in the fourth quarter of 2018 that took us to that low with a lot of panic in the market. So I certainly would not want to violate that low. But could we get there? I mean, I don't think we're going to 2350, but could we get there? Sure, we could. And if you're in, and with the VIX up as high as it's been, I think the longer you sit in a position, short-term position, as the market falls, the more difficult it is to get that money back from a trading perspective. And you might say, well, if you just sit there and you hold, if you think the market's going to go up, you could buy now, and even if it goes down, it comes back up. Well, the problem is the mentality. Long term, you don't have that mentality of worrying about where we are next week. Short term, the mentality, the emotional, the fear, all of that plays into your decision to buy or sell. And when you start trading emotionally as a short-term trader, I think you're done. If you start reacting to what the market is telling you, the market's going down, you're seeing the Dow go down 100 points at a time, and you start basing your decisions on that, that is not a good thing from a short-term trading perspective. So I just want things to settle down as a trader. Yes, there are opportunities. Today the market's up. Should have bought yesterday at the close, but how did you know? What if it's down at the end of the day? Then you could say, well, we should have shorted at the open. Well, yeah, it's easier with hindsight with all these big moves, but trying to do it proactively, I think, makes it really difficult. All right, so one of the things I wanted to talk about, let's go move on here. 10-year Treasury yield. You can see the big drop that occurred starting right about February 19th, 20th, when we broke down below 150. Remember, we had that long-term support around 135. We didn't even pause. Straight down. The bond market was screaming. I've been saying this bond market's screaming for a rate cut. They're screaming for the Fed to act. And not only were they screaming for the Fed to act, but the way the markets were acting, I think that it was almost a guarantee. I think the market said this is a lock. The Fed is going to cut. And the reason I say that, number one, is you can see the yields dropping. But number two, the dollar, all of a sudden, right around that same time, February 19th, 20th, 21st, that's when the dollar started taking the hit. So look at the 10-year Treasury yield, the big dive from 155 down to unbelievable yesterday, but we got down as low as 0.90 or 0.91. That's a pretty low 10-year Treasury yield. Of course, those around the world are saying, hey, we're negative. Come join the party. But I don't know if we go negative, but certainly this is an all-time low. I'm going to update just to see because this moves pretty fast as well. Yeah, we got up as high as 101.5 earlier. Now we're back down to 0.99. I think as long as money's rotating into treasuries, it's not saying the stock market can't go higher, but as long as this remains in play like this, it's going to be difficult for stocks to continue, for this to be more than just a temporary bounce. Treasuries, when money's going into treasuries, that's when we see the 10-year Treasury yield dropping like this. And we've been seeing money pouring into treasuries. When money pours into treasuries, that's money that can't go into equities. So it's not like there isn't money that could still go into equities. It's just that there's not as much. This is money that's investing based on fear going into the treasury market. So eventually we're going to get a pop in the 10-year Treasury yield. And when we do, we'll probably see a really good move in the stock market to the upside. But for now, we've got to deal with what we have to deal with, which is a lot of folks flocking to safety. Now, the dollar on the way back down here, I think finally the market's saying, well, the Fed's going to act. It's going to weaken the dollar. Let's get the heck out of the dollar. That's what I think's been going on here. It's been a pretty steady march now for the past few weeks. And when you look back, this is as big a drop as we've seen at any point in the last 6 months. And if I go back here and maybe just look at the last couple years, you can kind of get a feeling of how quickly the dollar has fallen. I mean, maybe there's a couple other periods Looks like maybe in June we had the dollar dropping, maybe August, September back in 2018, saw the dollar dropping, maybe right at the end of 2018, early 2019. But this is pretty steep. So I don't know. This has been about as big a drop as we've seen now. The Fed's cutting. And what really leads me to believe, I was kind of surprised we got this breakout in the dollar, because all of my inner market work that I do tells me the dollar should be weakening. And I think part of the fact that the dollar kept going up, I think there were folks saying, hey, the Fed's not going to cut. The Fed's been pretty adamant. You know, they're going to sit on the sidelines. And if they do that, then our yields should move up faster than other yields from around the globe, and that will strengthen the dollar. So I want to be in the dollar. Well, I think with this last drop in the 10-year Treasury yield, I think we're starting to see more investors and traders believing that the Fed was going to cut, and cut big, which they did. And I think that's why we've been seeing a lot of folks getting out of the dollar. Now, here's a chart when I talked about the intermarket relationships that I like to look at. Here you've got the 10-year Treasury yield in the US minus the 10-year Treasury yield in Germany. And I use it as a basis for what's our economy look like versus Germany's. And the reason I picked Germany is that, you know, I've looked at a lot of correlation with European countries and also other continents around the globe. And it seems like the correlation with the US is as close to Germany as it is any place else around the world. So that's why I like to compare the US with Germany. But when the yield is going up in the US, that's telling us that the economy is strong. And when it's going up relative to Germany, it's telling us it's stronger than Germany. So that's the reason why our yields should separate from Germany, should be moving up versus Germany. Now, we both might be coming down, but it might be the German Treasury yield is coming down faster. And as a result, this would still move higher. So it's just a relationship between the two. And when that's going up, to me, in my mind, I think our economy is stronger. And if that's the case, then the dollar should be stronger. Our currency should reflect that. And you can see the dollar does move up when this moves up. Now, for the last year and a half or year and 3 months, I have been seeing this yield on the Treasury yield here in the US versus Germany moving lower, telling me that economic improvement in Germany and maybe Europe is better than what we've seen. Maybe we're going to get a little bit more of a bounce out of some of the international markets. But the dollar has stubbornly continued to try to go higher, even though this yield has been moving lower. Look when the last time we came down with the yield. Look at what happened with the dollar coming down. Here we pull back, the dollar pulls back. Here we pull back a little, the dollar. Look at here, this yield, you know, relative yield coming down, the dollar falls. This time's been different. Is it going to stay this way? I don't think so. I think the dollar needs to drop. And I look at this correlation down here, and you can see that in the past, when we get a negative correlation of minus 0.5, we don't go down to -1. I mean, these two shouldn't go in opposite directions for a real long time. It should, you know, for the most part, they should go hand in hand to the upside. And that's what these positive correlation readings tell us. To the downside, though, you know, it's not going to be hand in hand. And every once in a while, one or the other gets off track. In the past, it's been when the yield keeps going up and the dollar goes down. That's when we've seen this inverse correlation. So this is the first time where we've seen the yields coming down and the dollar trying to go higher. And that's what's resulted in these negative or inverse correlations. I expect one or the other to line up again. I don't know if all of a sudden the US Treasury yields are going to go up or if the dollar is going to go down. But I think the yields are what they are. I think the dollar should be reacting to what's going on with the yield. So I believe the dollar's coming down. I think we're starting it. I think it's going to continue. I would at least like to see a test of this trend line, which would be down 94, 93. And if that happens for the first time in a while, we should be getting some tailwinds for energy and materials. When the dollar's rising, if you go back and you look at the XLB and the XLE and compare it to the S&P 500, since this dollar started rising in 2011, both the XLE and the XLB have been declining versus the S&P 500. They've been underperformers. If the dollar does begin to weaken, I would expect, even if it's just temporary, I would expect that the materials and energy group would lead. Now, when I look at crude oil prices, crude oil has been hammered here over the past 2 months. And it's on the coronavirus, it's on the global economic fears, and what's likely to be global economic contraction. We're already seeing it obviously in China and Italy and Iran and some of the other parts of the world where the coronavirus is spreading more and more. We're seeing more steps being taken that's going to cut into global the global economy. So crude oil prices coming down is not surprising. Watch this 42.5 level. I think we could get there, but I'd be surprised if we go below it. If we go below it, I think that's really telling us that the global economy is likely in much worse shape than we think. Now, here's the CRB index. So this is an index that tracks different commodities, and energy is a big part of this. But you can see commodities have been going down, but remember, February 19th, 20th is when we saw the dollar top. And look at what's been going on here. CRB's been coming down, but it's been actually outperforming the S&P 500. So this is something that we want to continue to watch, because if the dollar keeps dropping, if we do get a rebound in the S&P, we could see a little bit more of it weighted toward energy and materials. This is what I was referring to in terms of the XLB and the XLE. So we've been going down, but the dollar kept going up. Now here in February, we're starting to see a little bit of a pickup in relative strength. Not quite to a breakout, but we're close to getting to about a 1-month high. And we're not too far from about a 2-month high in the XLB versus the S&P. Energy has still it seems like nothing has helped energy. But we'll see whether or not, if the dollar keeps dropping, both of these could go higher, and especially I'd be watching materials. All right, let's take a look at some earnings. We're probably going to run a little bit over today, but that's fine. I know we got started a little bit late. Couple of earnings reports. Ross Stores, you can see moving up here into its earnings. It had pulled back recently with the overall market. Relative strength was just kind of okay. And I was looking at their earnings report. It came in $1.28 versus $1.26. They did guide lower, though. So the stock is down 2.4% pre-market. I'd watch probably these recent lows. I think if we hold and we start, repairing the chart, I think we're still okay. This is a really nice looking chart long term. Ross Stores has been a really good performer. Pull up the 15-year monthly chart, and you can see it's been a great performer. Rarely pulls back for very long. Can't say that about too many retailers. Let's see, another earnings report out. VEV, this is a good one. Viva Systems, this is in the software space. Stock had been holding on to some key support around 140. They did beat 54 cents versus 52. They guided higher. Stock is up 6% in pre-market. I don't think that takes the stock out of the woods for sure. I think probably we're still consolidating, but at least it beat the alternative of missing and guiding lower and breaking down. So at least for now, we've got temporary stall in that downtrend, or in that the threat of that breakdown, if you will. All right, let's take a look at another retailer. How about JWN, Nordstrom's? They missed on their earnings, $1.42 versus $1.48. On a relative basis, it had started rolling back over here over the last 2 months. Volume obviously picked up. Of course, it had picked up on a lot of stocks. But JWN down 7.75% pre-market. So it is looking to open below this low, and I would really watch 31 because if it doesn't hold that support coming off the bottom, that was the initial reaction low. If it can't hold those lows, it could return all the way back to the August low in the mid-20s. And from $33, that's still a pretty good drop. Let's see here. URBN, Urban Outfitters, another one in that apparel retail space. This one has not been a very good performer, down at a 52-week low. They came in way short of estimates, 50 cents versus 63 cents. Stock down 6% pre-market. Again, this is one of the reasons why you want to pay attention to relative strength, especially a stock trading at a 52-week low, relative 52-week low heading into earnings, and it's in a group that has been, improving, but you can see its relative strength has been very weak. I'm not surprised when a company this weak on a relative basis comes out and misses. Ambarella, AMBA, they guided revenues higher. They beat 14 cents versus 12 cents. Stock up 7% in pre-market. This one a little bit better in terms of relative strength. It did just recently in February move up to about a 4-month high, relative high versus the semis. And looks like it's going to get a pretty good pop today. One stock that is getting clobbered, and it's in one of our portfolios, not happy about this one at all. CDLX, Cardlytics, they actually beat bottom line 18 cents versus 8 cents. But they guided Q1 revenues lower, and it was quite a bit lower. And they've also shaken up management quite a bit. I didn't see all of the moves, but there were a number of key management positions. And you can see the stock down 31% right now. Gapping down. Now, remember, everybody, when a stock like this gaps down this much and volume is heavy, you've got market makers on the other side. One possible way to trade this if you're not in it, and this is very, very risky, so it's not for everyone. But if you're trying to get on the side of the market maker, if we go back above the open at 60.46, it could mean that the selling was exhausted, the market makers built a position, and the stock's ready to run. That is more of a day trading technique. So it's not for somebody long-term investing saying, oh, Tom said this was a good stock to pick up at 60. It has nothing to do with that. Please don't misconstrue this. It is strictly a very, very aggressive day trading technique that I have used before. And on a stock like this, this is a company that a lot of good things were built into it. It went from 40 to 110 in 3 or 4 months. I expected a better report than this, to be quite honest. It was near a 52-week high on the versus the internet stocks, and internet's been strong. Volume trends have been strong. So this one is kind of a shocking report, but it could simply be an opportunity if it reverses. Again, getting into a stock after earnings with this kind of volume and volatility is very, very aggressive. So it would be only for those of you who are really aggressive and don't mind, taking that kind of risk. Now, if it does get back up above that 60.46 level, and you can see already got down to a low today of 56.10. Now it's back to 59.79. If you do get in, for me, if it goes back down below today's initial low, I'd have to get out. So that would be, and that could happen quickly. So please keep that in mind. This is not a strategy for everybody. It's really more for somebody who's willing to take on a lot of risk. But the flip side is there is potentially a lot of reward. If this is an overreaction, I mean, this stock could be $70, $75 later today. So taking that risk, the potential reward is maybe heading back up to fill some gaps. That would be the alternative, the other side of it. Upgrades, downgrades. First upgrade today, Chipotle. The stock, let's see, give me an update, see where we are, get an actual price on the stock. We are up almost 5% on the stock. This is one of those stocks I think is going to be really, either it's been beaten down for no good reason because the coronavirus isn't going to be as bad as everybody expects, or it's been beaten down for a very good reason because the coronavirus is going to increase in terms of its spread. And, you're talking about a restaurant here where people serve you food. This is the type of an environment. I think I mentioned a week ago, Planet Fitness was another one. If we pull up that chart, you can see Planet Fitness with the coronavirus getting hit hard. Anytime you get companies that benefit from gatherings of people, those are the types of businesses that could be under pressure going forward if we continue to talk about the coronavirus and the spread. So Chipotle gets upgraded, but I don't know what to do with it, to be honest. This is in our portfolios. It's in, I guess, the model. I think it's the model portfolio. But the drop's been rough with the overall market. It's getting a pop. And again, from a portfolio perspective, those are long-term positions. They're only held 90 days, but you're in the market. You don't try to time the market with the portfolios. Trading is a different story. So if you're looking at those portfolios and saying, yeah, I want to trade some of those stocks, you know, Chipotle is just one of those, I don't know. I kind of just throw my hands up. I really don't know what to say about the company. I think it's a great company. I love the food. I actually like Chipotle and their burritos and everything. But, and I think that they've got a great model. Their profits have been soaring. It's been awesome. They're growing. But in this very short term with the coronavirus, who knows? I mean, it's just a very difficult call. One other upgrade today was Home Depot. Home Depot was up really nicely. Well, it's up about 2.5%. I think it was up more earlier when I looked. But the stock is up battling that 20-day moving average. On a relative basis, home improvement stocks have actually done pretty well throughout this. And you can see Home Depot near a 52-week high. I have no problems with Home Depot. Again, it's really the market. So if the market stabilizes, I like Home Depot. It's one of the leaders. Downgrade, OKTA. This is a software company. Stock is up even with a downgrade, but the market is up. We'll take a look at the market here in just a second. But OKTA starting to strengthen again versus its peers. It's been sideways consolidating. Clearly 141 is a major resistance level on this stock. So we want to get a close above that 141, 142 area. All right, let's go ahead and move on to the three you must see, and we'll wrap up the show. I'm going to focus on three stocks that have been in downtrends for quite a while. You know, I don't know if I'm going to offer up any hope for you, but we'll take a look at them and just see. First one, Tilray. You know, this is marijuana related. If you don't recall, this stock was a $300 stock during the hype. And I want to say the hype was a year and a half ago. Let's go back 2 years. Yep. So the stock ran from $20 to $300 in 2 months. You know, those types of moves without the fundamentals, we've seen it before. You know, if you're the last person holding that bag, it's not a fun feeling at all. Stock is now down 96% almost from that $300 high in September. I'm not really seeing anything yet on this one that gets me excited. I mean, you look at a relative strength, there's nothing going on here that I like. So I personally would avoid this one. The next two, though, are a little bit more interesting. And Tilray may become interesting. It's just got I want to see a little bit momentum and strength. I'm a momentum trader. I'm not a value trader. I'm not trying to catch a bottom. I want to see a bottom already form or be in the process of forming. And I think we could be possibly seeing that here with EXTN. So you're looking at in energy, and I mentioned energy earlier in the fact that if the dollar comes down, we could see energy and materials start to lead. And we've already started to see some pretty good volume coming in on these moves to the upside on EXTN. Overall downtrend clearly is in play, but look at the relative strength here just over the past couple of weeks, shooting back up on this volume. Now, it is a very aggressive play, and I would have it on my radar and maybe keep an eye on a couple of levels. And we broke out above about 675, so maybe first area of support, we might see some buying there. The rising 20-day, if this is truly starting here to move higher, watch the rising 20-day, which is $1 lower down at 609. You know, these types of companies, especially in energy, not too many folks are rushing into energy. There's not a panic to jump into energy right now. So you might get some better opportunities to see these on pullbacks. But I just wanted to point out, you know, when I start seeing the volume build on these moves, and then the volume's less on the pullback, and then you set a new high, starting to see a little relative strength, the dollar's lining up, all of those factors mean that, hey, this maybe is one worth watching. And then the last one I have is CC. This is in the materials area. And this is another one that you can see the huge volume. This stock was at about 15.5, and it went up to almost, 19.25 probably on very, very heavy volume. Second heaviest volume of the last 2 years here. So pretty big move. It did at least pierce above these reaction highs. They were up near about 1975. Looks like we got up to 20, went all the way back down, put in this double bottom. This is one that, you know, when it went up on heavy volume and broke out here, even if it was just temporarily, on that move, it did break to about a 7-month relative high versus its peer group. Now the group overall has not been strong, but again, watch the dollar. If the dollar keeps dropping, we start to see strength. This is one that's not too far from support. It's already shown a little bit of strength recently, got up to $20. I don't know, one to keep on your radar if you like to play these kinds of stocks. All right, apologize for all of the technical difficulties for getting started, but hopefully running over 10 minutes made up for it. Let's take a quick look at the market before I do go here. Right now, they got the Dow up 528, S&P is up 50, NASDAQ up 130. So we do have some pretty good action taking place here in the market right now. Whether or not this holds, my goodness, who knows? I mean, by the time I write the daily market report in another couple hours, I don't know what kind of market we'll be looking at. I guess I'll look then. One other thing I did want to mention earlier and just kind of forgot about it because of all of the difficulties we were having technologically. But Biden did win a number of states in the Super Tuesday yesterday. So just did want to mention that. It's a pretty tight race between he and Sanders for the Democratic nomination. But there were a lot of results there. You may want to check that out. Anyhow, everybody have a great day, and we'll be back tomorrow. I'll be doing this over at Stock Charts TV, Trading Places Live, getting started at 9 a.m. Hope to see you there. Happy trading, everybody.